It was a quiet day on Wall Street. We did end up taking some losses when it was all said and done. The S&P 500 was down about 0.78%. It does continue to have a bullish posture. In fact, several of the indices have a bullish intermediate confirmation signal as of tonight as well. But part of the negativity today was as a result of weaker than expected home sales. We also saw additional jobless claims. That number is now added up to about 39 million people that are filing for unemployment benefits here since the middle of March. And then we also heard a little bit of buzz about the possibility of delisting some Chinese stocks, at least if certain politicians in D.C. have their way. So some different news stories there affecting that negativity, but all in all, we continue to have a reasonably strong market that has been trending higher ever since bouncing in March. So we'll take a look at all that, see what it means for our posture. Then we'll get into our trade application example, where I wanted to do a bearish trade in a sector that has been struggling on a relative basis recently. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 21st, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe, check out our description area where you can sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me at Brandon Van Zee, and I really appreciate those of you that click like and retweet for these Market Outlook related posts to encourage us to do them as often as possible. And then lastly, we have a presence on Facebook as well. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into our chart action here today. As you can see, I've got chart 4B pulled up here in front of us, which is more of our traditional view. Remember that more often than not in the last couple of months, I've been pulling up the 1% move chart. Well, today's one of those rare days where we did not get a 1% move. So we just had a 0.78% sell-off in the market. In fact, remember, one of the things that you can look at on these charts is whether this final label up at the top is either blue or orange. If it's blue, like it is today in all four of those charts cases, it means that the daily range was smaller than the average true range. In other words, we didn't have as much volatility on a high to low basis here today compared to typical trading activity in the days before this. And so that was the case. In fact, it was the case by quite a long shot. Those were very low daily range numbers compared to the average true ranges that you had been seeing in the last few weeks. Anyway, I mentioned in the intro that we do have some bullish intermediate confirmation signals, but it's very similar to my commentary that I had for you on Tuesday night's video for those of you that watched that, which is, yes, they exist, but they're not considered ideal setups. So let's kind of review that. On the S&P 500, you can see that the green intermediate line is considered strongly bullish right now. We know that because it's in the upper reversal zone. So whether that green line is traveling up or down, as long as it's above 80, we consider that strongly bullish. And that is the case with all four of our charts. Even the Russell 2000 managed to get its green line into the upper reversal zone today with an 81 reading, so just barely above 80 there. So anyway, with the S&P 500, we've got that bullish posture according to that green line, combined with a red line in the lower reversal zone on the same day. So, we had this similar setup on Tuesday. We had the red line down here and the green line in the upper reversal zone. And so on Wednesday, which would have been yesterday, we had to pop out of that. So that somewhat worked, right? We had to buy the dips signal with that bullish intermediate confirmation signal as of this candle, and the next day was a nice up day. It was a nice 1% update yesterday. Well, here we are back again with a pullback in the market. We have now seen that red line dip back into the lower reversal zone to give us yet another bullish intermediate confirmation signal, but same problem that we have, or that we had on Tuesday, is the same problem that exists today, which is the blue line is not considered in an ideal placement here. We'd like to see this blue line between 50 and 20, and right now you can see that that blue line is up here at 66. So we haven't really had enough of an exhale yet to get truly comfortable with a buy the dips mentality. For those of you that are a little braver, perhaps you go into it regardless and you position size accordingly, knowing that it isn't an ideal setup, so maybe you do half the position size that you typically would. But it exists, so I'll point it out. In the same thing can be said over here on the Dow Jones Industrial Average, same setup there, and we also have the same setup down below here on the NASDAQ Composite. The Russell 2000 is a little bit different. It was pretty much break even today, so it didn't really move all that much today, but remember that means that it was a relative winner today, right? This candle right here is basically closed where it opened today, whereas these other candles, you can see that it's more clearly red. So the other indices were down today. The Russell 2000 was effectively flat. So in other words, it outperformed on a one-day basis. And that was enough to see the green line head up into that upper reversal zone, as I mentioned before. So that's a positive sign there for the Russell 2000. But you'll notice the difference in the red line, right? With the other three charts, the red line is in the lower reversal zone. With the Russell 2000, it's not, because it didn't close at the low of a recent range here. The Russell 2000 managed to basically close in the middle of today's range, so it allowed it not to have its red line fall into that lower reversal zone there. So the Russell 2000 is the only one that does not currently have a bullish intermediate confirmation signal. You can see that all four of our charts do continue to have that dark green background color, telling us that we do have bullish intermediate postures across the board. In fact, strongly bullish intermediate postures. And then we also see that all of the moving average lines are currently colored green as well, telling us that price remains above a rising moving average. And so those would be considered bullish things, all else being equal. Let's go ahead and take a look at our three green arrows set up now, and this is going to be our chart 4D. As we pull this up here, you can see things have changed since I was with you on Tuesday. On that day, we only had the Dow Jones Industrial Average that had three green arrows. Today, we have all four of our charts with that. And I didn't get a chance to catch David's video last night, but I'm sure he probably brought that up with you yesterday as well, since it actually happened yesterday. But just to confirm, we do have three green arrows on all four of our charts at this point. For those of you that are newer, three green arrows is just simply three different technical indicators that are lining up more bullishly than bearishly right now. The first green arrow would be associated with the 30-day moving average and whether price is closing above or below it. The second green arrow is going to be associated with the MACD histogram and whether it is closing above the zero line or not, which is a sign of momentum. And then the third and final arrow would be, in this case, the stochastic, and that is giving us a sense of whether the bulls or the bears are in control of the price action, judging by where a security is closing compared to its recent range of trading. So in all four of our charts cases right now, we do have green arrows, and it has been a reasonably bullish week. Speaking of which, let's go ahead and take a look now at our next chart, our 1040 crossover method chart. And that is going to be, I always lose my eyesight here. There it is, 4C. Hidden just where it always is, right? Anyway, 4C here will show us the 1040 crossover method. And on these charts, we're using weekly candles, not daily candles like you typically see with the other charts that we show you. So this is a longer term time period that we're looking at with this particular chart setup. Each one of these charts goes back 3 years, and each one of the candles is one whole week in length. And as you can see here, we do continue to have a bullish crossover on the NASDAQ Composite. However, we don't have bullish crossovers on the other three charts. But this is a decent week. You can see that most of these candles here, at least with the S&P 500, we at least touched a new high at one point this week. And you can see those two lines pinching a little bit closer together, the blue line and the orange line. The blue line is the 40-week moving average. The orange line is the 10-week, the blue line is the 40-week. So when they're pinching together like they are right now, it basically means they're closing the gap, and there is some momentum in the price that is suggesting that if things continue as status quo into the future, we will receive a bullish crossover sooner rather than later. So you can see that it's the S&P 500 the closest to being able to accomplish that, because those two lines are pinched the closest together, whereas we still have quite a bit of separation over here in the Dow Jones and quite a bit of separation over here in the Russell 2000. So if you're expecting to be bullish going forward, it would be the S&P 500 that's most likely the one that's going to be able to pull that off. And remember, the S&P 500 right now is really being driven by Microsoft and Apple and Facebook and Google and those companies that are also part of the NASDAQ composite. In other words, the big tech companies. They are more influential in the S&P 500 than they would be in the Dow Jones Industrial Average and the Russell 2000. Sure, the Apple and Microsoft are part of the Dow Jones, but you're not going to have, you know, some of the others like your Googles and your Facebooks in there. So anyway, you do have a bigger influence on mega cap tech on the S&P 500 and the NASDAQ composite, and since that's kind of the area that's been hot lately, then those are the areas that benefit from that. Whereas the other two areas, the Dow Jones Industrial Average and the Russell 2000, really don't get any sort of positive benefit from that particular trend. However, we do still, you know, see bullishness out of those other areas. It's just not as extreme bullishness as we're seeing with the mega cap tech area. All right, moving on now to our 12 grid analysis. Let's start with chart 5A. This will be our asset class 12 grid. And as we pull this up, you can see a lot more green charts on the board than pink charts. So maybe we'll start with the outliers, the pink charts here. First of all, we've got the long-term U.S. Treasuries. They were actually up today, only up 0.25%. Nonetheless, they were higher today. However, we continue to have that strongly bearish posture there. And we also have them trading below a falling moving average, which is why that moving average line is colored red here currently. And the same thing can be said for US dollar down below. It is also trading below a falling moving average. So both of those things could be gearing up for bearish trades depending upon what your perspective was on things. You know, with TLT, it's one of the rare bond funds that you can actually get away with doing spread trades on from an options perspective. Most bond trades don't really give you that luxury, but TLT is really liquid and it has a lot of different strike prices that are available to traders. So, you know, you're looking at this chart and it's been mostly sideways for the last couple of months. Perhaps doing something like an iron condor would be useful in this type of an environment that we find ourselves in right now. US dollar was up today as well. So both the US dollar and long-term treasuries were up, despite their intermediate postures being strongly bearish and having them trading below their falling moving averages. Now, a lot of times when the US dollar is up, the commodities struggle on a relative basis. That was the case here with gold today. Gold actually fell kind of out of bed today, unfortunately. This is an area that I've been watching very closely and have been impressed with how strong it's been in the last several months. Today was a pretty ugly day. It was just a black eye. It's, you know, it's not down and out. Obviously, gold is still trading above a rising moving average, and the background color is green, telling us that the intermediate posture remains strongly bullish. But this was a pretty aggressive sell-off day for it. You know, you don't see a whole lot of those types of days, and so it was unfortunate that it fell out of bed. And we're actually trading at about our 1 week low on gold right now. So we're going to want to watch that. Remember, this is kind of your make or break moment. If you're bullish on gold, you want to see a bounce out of it tomorrow. And we did get a bounce on an intraday basis. You can see we did have kind of a long lower shadow on that candle right there, where it did come down to that moving average, bounced off of it and closed off of its lows for the day. Nonetheless, this is an area where if you're expecting bullishness going forward, you'd really like to see a bounce out of GLD and gold tomorrow as it's kind of testing that upward trending 30-day moving average. So we'll keep our eyes on that. It looks like USO was up nicely today. It was up 5%. These days, USO is somewhat disconnected from the crude oil future. So let me just verify with /CL. And here, they might have already rolled over for the day because it's a little bit later in the night when I'm doing this video. But you can see it looks like crude oil was up on the futures contracts here as well, although not up as much as USO itself. So anyway, we have seen some positive movements out of those areas, and that's more than we can say from where we were at about a month ago when we were talking about negative oil prices. It looks like we're kind of past that moment in time for right now, thankfully, and hopefully on the road to recovery to a degree with some of those oil trades there. In terms of the stock charts that you see up at the top, you can see that the U.S. stock market remains strongly bullish. The developed foreign stocks remain strongly bullish, and the emerging foreign stocks remain strongly bullish. However, today was a pretty ugly day. You did see that EFA was down over 1%, and so was EEM. So more than 1% givebacks on both of those foreign indices there. Part of that might have been as a result of what I mentioned before. The U.S. dollar was up today, so remember the U.S. dollar also impacts foreign securities in addition to impacting commodities. So perhaps that's all there was to it. I also know that there's some of the areas of the world like Brazil and Russia that are really struggling with the coronavirus outbreak at this point. So maybe that found its way into the stock pricing as well. Anyway, let's go ahead and take a look at our next 12 grid. And we'll go over here to chart 5C. In this case, this is the U.S. sectors 12 grid. Now, one of the things that I sent out on Twitter, and then for those of you that are premium members, I also sent it out via Telegram last night, is I did create a new chart. So be aware of it. I'm going to bring it up now because it involves sectors. So 5C we've had for a long time. This is what I use pretty much in every one of our presentations that we do here. I also added this one last night. This is the equal weight sectors. This is going to be chart 5R going forward. And for those of you that are premium members, you have the ability to import all 49 of our charts that David and I use, not only here in our Market Outlook presentations, but of course also in our daily trading rooms that we teach for our premium members. So if you are a premium member, remember you can come on over here to our website, and you can hover your mouse over the Tools tab, come down and click on Premium Resources. Once you're in that area, then just scroll down to the Thinkorswim charting importation tutorial, and in there you'll see all the shared links for our 49 charts, including that one that I just updated there last night. Now the reason that I did that is because of, first of all, we had access to do it. There are now enough equal weight charts out there where it's usable. For the longest time, that was not the case. We just only had the market cap weighted. But in addition to that, we've seen a lot of interesting developments in terms of market cap and its impact on the stock market. We've talked about how Apple and Microsoft and Google and Facebook are really and Amazon are really affecting the pricing of the S&P 500 itself, because the S&P 500 is a market cap weighted index. But remember, that's also happening on the next level down with these sector charts that we traditionally look at. So let me take a look at it here. And you'll see all these normal like XLC, XLK, XLB, etc. So these are all your market cap weighted ETFs. And these are still way more liquid. The equal weight ones are a great idea. They just haven't really caught on in popularity all that much. So if you're looking for liquidity in terms of trading options and things like that, you're still going to want to stick with these original ones here. But remember that when you're looking at these, they are impacted in some cases by just a handful of securities. What comes to mind specifically with consumer discretionary is Amazon, and then to a somewhat lesser degree, Home Depot. Those two stocks really make up, I want to say it's like a third of XLY. So, you could theoretically have a situation where Amazon and Home Depot are just knocking the cover off the ball, going up at a furious pace, but the entire rest of the consumer discretionary space is drifting lower, and this chart would look like it was bullish. So that's the downside. And you could say the same thing with energy. Chevron and Exxon make up a considerable portion of the energy ETF XLE, and Microsoft and Apple make up a considerable portion of the technology XLK, and then you've got Facebook and Amazon, or not Facebook and it would be Facebook and Alphabet or Google, however you want to say that. That would make up a considerable portion of XLC, the communications. So now that we have the ability to, I figured it would be useful from an educational perspective on occasion to also look at things from an equal weight perspective, which will be chart 5R. So if I click on that, you'll probably see a bunch of ticker symbols that you don't recognize here. And remember, in case you're not as familiar with this stuff as others, what I've done in the labels is, as you can see up here, like where it says communications, I put EW in parentheses there, just to remind you that this is the equal weight version, because these ticker symbols are not going to be nearly as recognizable for many of you that have been around for a while. They weren't even recognizable to me. So like EWCO is the equal weight version of the communication stocks in the S&P 500. So one way that you can kind of get a sense of whether there's any differences or not is just by quickly scanning to see what the colors of the charts are. And there is one example I can show you in that case right now, because down here at the bottom, you're going to see that the real estate in the bottom right, the real estate equal weight fund has a light green background color right now. The reason behind that is the green intermediate line on the market forecast technical indicator is at 46 and rising. So that's a weekly bullish posture. Now, if I were to go back on over here to our normal sectors 12 grid, which is a market cap weighted version, and that's again going back to 5C, notice the difference down below. Down here, you see the real estate chart XLRE, which is market cap weighted. It has a dark red or dark pink background color, telling us that we have a strongly bearish posture. So one of the charts says we have a weekly bullish posture. This one says we have a strongly bearish posture because its green intermediate line on the market forecast is at 36 and falling. So that would be one way for you premium members to be able to kind of compare and contrast to see, okay, are these charts jiving with one another? Are they in conflict with one another? And try to discern why that might be the case. So we'll keep our eye on that in future sessions as well. But in the more traditional analysis that we would do here, you can see that it is the bottom three sectors that are bearish at this point. That's your staples, your utilities, and your real estate stocks, whereas all the rest of the charts on the board continue to be green, telling us that they are continuing their bounce for the most part from where they were in March. And you can see from the trading and the placement of the candles that that seems to make some sense as well. You can see that the three bearish charts at the bottom are the only three on the board where you see price below a falling moving average. Remember, those two things do not have to be in sync with one another, but they are right now. So it is a reminder that it does seem like those are the weaker areas. Consumer staples is right here below that falling moving average. Utilities is right here below that falling moving average, and real estate is right here below that falling moving average. Whereas you look at all the rest of the charts and they're all either above a rising moving average, or in the case of the financials, basically sitting right on the moving average itself. So anyway, that seems to make some sense as far as what I'm seeing in the market there as well. As I mentioned to you on Tuesday, it does appear that the communications area is one of the strongest areas if you're going to read the numbers within the intermediate label. However, there is a slight change here today where you do have consumer discretionary a little bit better. Now remember, that's one of the charts that's going to be most influenced by one single stock, and that one single stock is Amazon. So Amazon is right here. You can see that it touched a new high here earlier in today's session. It did end up selling off by the end of the day, so I don't know if that's a bad omen, but it did hit an all-time high this morning. And so that influenced XLY. My guess, and I didn't catch this when I was looking at the equal weight version, but I'm going to test my hypothesis here. My guess is that when we go back and look at the equal weight version, its intermediate line is not 94.95 and rising. My guess is it's going to be a smaller number than that. So let's test that hypothesis by going back on over here to chart 5R and look at the discretionary chart. And you can see that hypothesis was correct in a big way. I mean, that is a major difference there. You're looking at XLY up there with an intermediate line at like 95. In this case, with the equal weight version of discretionary, which is ticker symbol RCD, you can see its intermediate line isn't even in the upper reversal zone yet. It's rising, and it's at 79, so it's knocking on the door of that, but you're talking about 15 points of difference there. And that 15 points in difference is effectively Amazon and Home Depot effect, right? They've been doing really well, whereas a lot of other retailers that are out there, some of you saw me tweeting about Ross Stores here this evening. Ross Stores is the first legitimate dividend cut out of the dividend aristocrat list. Now, Ross Stores isn't quite as well known to be an aristocrat like Coca-Cola and McDonald's and Procter & Gamble, because Ross Stores was actually just added to the Dividend Aristocrat list in January. How's that for an introduction? You're on the list and then immediately going to fall off the list. So anyway, Ross Stores reported their earnings after hours tonight, and they followed in line with one of their big competitors, TJ Maxx or TJX, and suspended their dividend. And so there's been a lot of stories like that within traditional retail, right? They're not Amazon, they're not Home Depot. They're just kind of run-of-the-mill companies. And so a lot of those types of companies, whether it's Macy's or Dillard's or those department stores, a lot of those discretionary stocks are struggling right now. But you wouldn't necessarily know it if you're looking at the chart of the traditional XLY. XLY, again, has been a very strong, steady uptrend right there, and is at basically 95 on the market forecast intermediate line. So that can kind of give you a way, those of you that are premium members that have access to our charts on your own when you're not watching David and I's presentation, to be able to do that on your own, to kind of compare and contrast, okay, where are we seeing strength versus weakness on market cap weighted versus equal weighted, and be able to kind of draw your own conclusions from that, and maybe develop some trades from that as well. Another thing that I thought I would point out over here on the internet, first of all, again, thank you to everybody who clicked like and retweet and all that kind of stuff for me. The last time I did the video, looks like 116 of you did that here. The last time I did the video on Tuesday. Anytime we're up and over 100, I really appreciate that, and I don't think twice about the time and the effort that goes into creating these free videos for you guys. Once we start getting that number below 100, then we start second guessing whether it's worth our time or not. So please keep that up on your side of the equation. You guys are doing a great job with that, and thank you once again. But while we're over here, I wanted to show you the sector selector that I created last weekend. I usually do it on Friday nights. And I wanted to point out something that's going to impact our trade application example, and that is real estate. You'll notice that real estate went to the bottom slot here on the sector selector in the most recent rankings. We'll see if that continues to be the case with tomorrow night's post, but as of this moment in time, that's kind of how we're operating. Technology, communications, healthcare, discretionary leading. This is a market cap version of it, and then real estate lagging. And one thing that's important to note with real estate is 3 months ago exactly, it was ranked third. So this is a kind of a rare example where you went into the top three down into the bottom three. And real estate has really been one of those areas that has been struggling. And of course, we saw that here a moment ago when we were looking at the 12 grid charts as well. So let's get into our trade application example now and talk about a bearish trade on a real estate stock. And so for that, I'm going to come on over here to chart 3A. This is our swing trading chart. And I'm going to pull up ticker symbol PSA. And this is public storage. And as you can see, this particular security has been forming a series of lower highs and lower lows here for the last several months. Like a lot of securities, it had an extreme sell-off here in March, followed by an extreme rise in a couple of weeks into the end of March. But unlike the rest of the market, this one has continued to drift lower ever since that time period, whereas you can see that the S&P 500 dotted gold line that's also plotted on this chart has largely continued to go up. So you kind of see this X effect that took place, where you had your public storage from the upper left to the lower right, and you had the S&P 500 from the lower left to the upper right. So you're seeing them, basically being plotted in different directions right now. So that's telling us that at least on a kind of more near-term basis, we are seeing weakness in public storage itself. So what I thought we would do here tonight is just a simple swing trade where we're short selling the stock itself. Now remember, you'd have to do this in a margin account. You can't short sell stock in a retirement account, but you could, of course, buy puts or do different bearish options trades if you're given that ability. But in this case, I'm just going to highlight how to do a simple stock trade. But instead of buying a stock, we're going to short sell that stock, hope that it goes lower, where we can then buy it back at a profit. And what I typically do is use a one-for-one reward risk mentality. And I want to pick out an important part on the chart where I don't think that the stock can go back up above in this case. And what I've selected here this evening is this candle for my bogey right here. And this is the candle on May 8th. And the high price on that candle, so you can look up here where it says H colon, and then when I point at that candle, the high price was 191.65. So I want to put my stop loss 2 pennies above the high of that candle. In other words, as long as it doesn't go above the high of this candle, then my trade is safe. It would have to cross above above a falling moving average in order to eventually get back up here and stop me out. And if that happens, so be it, right? We're going to lose plenty of trades as swing traders. So I don't necessarily fear that sort of a thing, but basically you got to figure out a way. Where are you deciding you're wrong? I'm going to decide we're wrong if the stock ends up going above the high of this candle right here. And so if we get our calculator out, I can put that number in there that I read off a moment ago. 191.67 is where we're going to put our stop loss. So let's subtract from that the current price, which is 182.77, where I assume to get filled tomorrow morning when the stock market opens up again. Whether that happens or not is anybody's guess, because stocks could gap up or gap down without me knowing it in advance. But that's where it closed here today, and so therefore I'm hoping it opens right around there tomorrow. So when I subtract those two from one another, that means that I'm taking $8.90 per share of risk. And if I wanted to maintain the one-for-one reward-risk relationship, that means that I could then take $8.90 and lop it off the current price of 182.77. And that means that my target price would be down at 173.87, which, as you can see on the chart here, would be around this level right here. So in other words, we would be checking out these candles right here on the 14th and the 15th. And if this stock could push down to the lows of those candles, we would be getting out of that trade with our profit. On the other hand, if this doesn't roll over and continue with that bearish near-term posture like it has right now, instead reverses higher and goes above that candle back there on May 8th, then we'd be stopped out of our position. So in order to set up that trade, I'm just going to right-click on the chart. I'm going to come over here to buy custom. Sell custom, my apologies. This is a short sale, so we need to go to sell custom with OCO bracket. So I'm going to click on that. That loads up our trade down below. Now, obviously, you're going to want a position size for your size of portfolio, but for this paper money account and for educational purposes, I'm just going to leave it at the default of 100 shares here. I'll click that paperclip icon together to lock all those lines together. And then here where it shows the price of where I want to sell this, I am going to try to sell it at 182.77. And again, that's where it closed today. So as long as there's not some major movement in the market, I should be able to get filled at that price tomorrow morning. I'll put that in as a good till cancel order up there at the top as a limit good till cancel order. Now the line directly below it, that's a green line. In that case, it means buying back the shares that you had sold from two different vantage points. The first one is, where do you want it to go? Where's your profit target? And that'll be the smaller number in this case, and that was the number that we saw on the calculator of 173.87. And we're going to change that to a limit good till cancel order as well. And then the line directly below that in green where it says day, we're going to change that as well to good till cancel. That one will be associated with where our stop loss is. And remember, on a short sale, our stop loss will be the higher number. In this case, that was 191.67, or 2 pennies above the high of that candle that I showed you before. So let's go ahead and click confirm and send. Everything looks fine there. You can see the base is minus $8.90. on one of the buybacks, and the other one is plus $8.90. So that, in other words, means that this is an equidistant trade idea here, 1-for-1 reward risk relationship, assuming we get filled at that 182.77 tomorrow morning, which is anybody's guess. It depends upon what the stock market itself is doing. But this will at least highlight the idea of how you can place a trade like that in your own paper money account. So let's go ahead and send that in, and we'll see if we can get filled first thing in the morning on that. Thanks again for joining me here this evening. David will be back with you tomorrow. Of course, for you Premium and Plus members, we've got a couple of great classes coming your way tomorrow. First thing in the morning is my Options for Long-Term Investors class, where I want to discuss a rolled short put that I had initiated earlier this week, in addition to putting on some new trades. And then a couple of hours after that will be David's quite popular technical analysis trading room. So for those of you that want to learn from a CMT, then of course you have that opportunity with David tomorrow. So make sure you're checking out those excellent resources as well. So with that, I want to wish you all the best of success with your trades and your investments. If you got value out of tonight's video, please go over to Twitter and click like for me there. And have a great weekend. We'll see you all next Tuesday. Remember, Monday is a holiday, but I'll be back with you on Tuesday's video after the market is open that particular day. All right. Have a great rest of the evening, everybody. Take care. Bye-bye.